Markets sold off today after Fed Governor Brainerd had a little bit more hawkish commentary than the markets were anticipating, and so we did see interest rates skyrocketing higher once again, which led to a sell-off in the bond market. We also saw the US dollar spiking, which led to a little bit of a sell-off in commodities. So there were a lot of different macro events taking place here today. We also saw a clear division from a sector perspective between the winners and the losers. And the winners were on the defensive side of the sectors, and the losers were there with kind of the more cyclical and growth-oriented areas. So we'll talk about all that, see what it means for our posture. Then we're going to get into our trade application example, where I wanted to focus on a little-known consumer discretionary stock that's starting to sell off at a much more attractive valuation and nearing an attractive buy point for a long-term dividend growth investor, but I'm going to show you how to sell a put with that particular situation. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 5th, 2022. First of all, welcome aboard. For those of you that are new, remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos, and also give you a heads up as to which stocks are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. I would encourage you to click follow if you're not doing so already. And we also appreciate those of you that help us along with the likes and the retweets. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. Starting with our heat map of the S&P 500, you can see it was largely a sell-off day here today. There were some areas of green. Thankfully, it wasn't a complete wipeout, but they were a bit few and far between. I would say that the utilities space caught my eye in terms of the consistency of the green. You can see down in this kind of general lower right-hand corner here where the utilities I'm circling, most of those are green squares. There were a couple of them that ended up in the red, but I would say probably 80 to 90% of the utilities did close higher today, so that was a good, strong area. I also like what I see out of the healthcare area. A lot of those bigger companies in healthcare, right? With the utilities, there's a lot of smaller companies there, so they don't have a very big impact on the overall market, unfortunately. When you get into the healthcare area, you get some bigger players there. They're still not as influential as what we see over in technology, communications, and discretionary, but nonetheless, there's some big players like United Healthcare, Pfizer, Johnson & Johnson, AbbVie. All of those were up nicely here today. AbbVie just keeps on gunning for the skies. That's been a remarkable story to watch play out over the years, as that's been a stock that we've been buying consistently for the last 7-8 years in my dividend classes that I've taught folks both here at Market Scholars and then previously at TD Ameritrade. So it's been really interesting to witness a stock that has had its fair share of haters along the way. And to be fair, there's been reasons for that, as they're about to hit a patent cliff with their Humira drug. But the stock just keeps on defying those that doubt it and just keeps on plowing higher. So a lot of you that may own it, at least you have something going well for your portfolio there today. In terms of other areas, I would say that the consumer staples probably managed to hang in there reasonably well. We've got quite a few green patches in that particular area there. And that's probably about it. Otherwise, it was kind of hit and miss in looking for some of those green areas. I do notice a lot of, some of those dividend aristocrat types of companies out there. McDonald's was up today. Lowe's was up today. Procter & Gamble was up today. Colgate was up today. Walmart was up today. Pepsi was up barely here today. NextEra Energy was up today. Already talked about Johnson & Johnson and AbbVie. There's automatic data processing. So all of those that I just rattled off there are dividend aristocrats. So it did seem like the dividend growth investing realm held up a little bit better today. We actually talked about that a bit in my dividend growth investing class earlier today for our premium members, and how that particular strategy within the market has been hanging in there reasonably well in 2022 versus versus a number of other strategies. Now on to the losers, however. There's a lot more to see in terms of the red squares here, but I think a big chunk of it is kind of concentrated in this technology area. That's the area in the upper left here, and you can see in particular NVIDIA got smashed today. It was down more than 5%. You can see that Qualcomm was down over 5%. Salesforce was down 4%. Even some of the bigger players out there like Microsoft and Apple were down 1 or 2% there as well. So they're going to do the biggest damage on something like the S&P 500, which by itself was down over 1% today. But without a doubt, a lot of brighter red squares here all of a sudden in some of those growthier, more kind of cyclical types of areas, whereas it seemed like our bullishness, if any, today came from more of the defensive areas. Healthcare and utilities and consumer staples are kind of those areas that you hunker down in when you're concerned about growth out there. And keep in mind that interest rates were a big story here today when we had Lael Brainerd come out and suggest that they were going to start kind of reducing their balance sheet at a much more rapid clip than maybe expected by the market. I think that kind of scared market participants. We saw interest rates spiking, and remember, a lot of these growth stocks, especially in the technology area, do have some interest rate sensitivity because of the discounting mechanism of the cash flows over time. And so we don't tend to always think about them as obviously as we might think about things like utilities and REITs and financials when it comes to that conversation about interest rate sensitivity. But definitely the growth stocks have been taking it on the chin anytime there's a big spike in interest rates, and we're seeing that play out yet again here today. You'll also notice that Tesla got hit pretty hard today. Of course, the big news yesterday being Elon Musk taking a 9% stake in Twitter, somewhat surprisingly, and watching Twitter's stock roar higher. It was up, by the way, again today, another 2% on the news that not only did Elon Musk take a big position of 9% of the company, but he was also introduced as a board member of Twitter, just like that, with the snap of the fingers as well. So it'll be interesting to see what sort of an impact Elon can have on Twitter as a service moving forward. But so far, investors are cheering that on at Twitter at least. But over at Tesla, things took a little bit of a tumble here today. Amazon struggled as well, down over 2%. And then Alphabet was down about 2%. Meta was down nearly 1%. Netflix down about 3% there. So those are some of your big FANG types of stocks that had been leading this market for years and years and years. More recently, they've been struggling a bit more as we've been dealing with a bit more chop and slop here in the market. Let's go ahead and move on over to the main part of the platform now. I'd like to pull up this particular area as well when we have a big move up or down, just to get a sense of market breadth. And it obviously had a more bearish tilt towards it today, but it wasn't anything tremendously overwhelming in my eyes. You can see that 144 stocks did manage to close higher here today, so it wasn't a complete washout type of a day. That's good for about 28 to 30% or thereabouts. Those stocks that managed to close in the green, with the remainder closing in the red. So naturally, when stock market is down, you should assume that more stocks are down than are up. But in a day like today, where we had a big down day, well over 1%, I would have actually expected this number to be a bit more overwhelming. So I guess maybe that's the good news if you're looking for it. In a day like today, that was pretty ugly. There were still a lot of stocks that managed to close in the green. If we're to look at the charts now, you can get a sense here as we pull up chart 6D, how often we are having these 1% moves. And it does feel like we've had a lot more 1% moves here in recent months. We kind of had a bit of a quiet period from that perspective back here in the summer and fall of last year. You'll notice that, we had a few of these green bars that would spike up past the blue on the upside, and a few of these red bars that would spike down past the blue on the downside. But for the most part, we were kind of contained within those blue bars or those blue horizontal lines, I guess you could say, during this time period that I'm kind of circling with my mouse off to the left-hand side here. Now compare that with your eyes to what we've experienced over in this general area off to the right, and it is like night and day. Here you get the sense that most of the days have been more than an up or down 1% day, right? Most of these candles are going either up past the blue line or down past the blue line on the downside. So we've had much more exaggerated trading here since the beginning of this year, and I think most of you are probably well aware of that. Also, keep in mind that when stock market falls, more often is the case than not that the VIX rises, and so you can see down below here with this purple line, we did have an uptick in volatility today with the VIX closing near 22. Let's go ahead and pull up our 4 grid now. This is chart 4B. So as we're pulling this up here, a reminder that the background colors of the charts here on this particular chart setup will tell us what the current posture is using the market forecast technical indicator, which is one of a couple of hundred of technical indicators over on the Thinkorswim platform. So it is kind of what drives our conversation in this YouTube video more often than not, but obviously it's nowhere near perfect, so we have to keep that in the back of our mind as well. Do your best to add the information you're hearing from us in this video to the other things you're learning about the market, as nothing will ever be perfect, but give us a general sense as to how trends are shaping up and helping us understand what's taking place within the market. And you can see that after today's selling, we still have 3 out of these 4 charts that remain with a strongly bullish posture. So that's the good news, right? We've had a pretty strong move off of the lows here about 3 weeks ago or so. And so we can afford to have some give back days like we had today because we kind of out-earned our potential on the upside in that reversal type of a move that we've been experiencing. However, there is one exception to that rule, and that is down below in the lower right-hand corner. You'll know that the Russell 2000 was down over 2% today. It was our worst performer, not by much. It just barely was worse than the NASDAQ Composite, which was down 2.26%. So Russell 2000 was down 2.36%. So very, very close to one another. Nonetheless, because of the range that this one has been trading in recently, notice that the background color of the Russell 2000 now has a pink background as opposed to the greens that we still see on the other 3. So what that is telling us in a color format is that we now have a weekly bearish intermediate posture. Remember, when you hear David and I use that term intermediate posture, what we're referencing is this green line on the market forecast technical indicator down below all 4 of these charts. And you can see in the label here, if you ever forget, some of you might be brand new to these videos and you might not remember, well, what's intermediate versus near term versus momentum? So in the labels itself, it can kind of help act as a legend per se. And just remember the color of the label here, green, where it says intermediate, will remind you that this green line is the intermediate line. And that's what drives the background color changes of these charts as well. If you're looking for this on your own Thinkorswim platform, remember it's not you're not able to access this particular setup. If you are a premium member of Market Scholars, we do give these shared chart links all to our premium members there. But if you're just a general user and watching us on the free market or the free YouTube video and looking for the market forecast technical indicator on your own Thinkorswim platform, it's there. It just doesn't have all the bells and the whistles that you see here in front of us. That makes our job of reading it a little bit easier. But because this was such a sell-off day here today, and we are so far away from the high that was printed here on March 29th, that was enough to push that green line out of the upper reversal zone. So while the NASDAQ Composite had nearly an equally strong sell-off today, notice that it is still reasonably close to where it was on March 29th. The Russell 2000 appears, with my eye at least, to be quite a bit further away from it. You'll also notice there was that red dot there on the Russell 2000 on the 29th. And that was an overbought cluster signal. Now, at the time, I didn't really think too much of it personally, but obviously each day presents new information for us to potentially change our mind if needed. And with this one selling off a bit more aggressively, I will say that my mind is starting to slip a little bit more bearishly when it comes to the small caps. However, I do think that you still have a chance to see a bounce from this level on the Russell 2000. You'll notice where we closed today was just above the rising 30-day moving average. So notice that line right there is still green. The line itself, that represents the 30-day moving average. And when the moving average is tilted higher and price is still above it, the line is green. Now, if this falls again tomorrow, let's say the Russell 2000 falls another 1% tomorrow, at that point, then this moving average color would change to most likely yellow, possibly red, but more likely than not yellow. And then that would be yet one more piece of evidence to suggest that the small caps just aren't quite firing on all cylinders at this point. So we're starting to see some of those warning signs here. And remember, for a while, we kind of felt a little bit more comfortable with the idea of the Russell 2000 being above that moving average. And just like that, within a week or so, we're right there calling that into question once again. So it's going to be interesting to see how it shakes out. You can see all of the labels at the top of the Russell 2000 chart are all red. So whether you're looking at year-to-date, 3-month, 6-month, or 1 year, red labels suggest negative price performance on the Russell 2000. Remember, that's the only index that can make that claim. The Dow Jones has been up over the last 6 months and 1 year, as has the S&P 500. And while the NASDAQ Composite has not been up over the last 6 months, it's at least still up where we were exactly 1 year ago. So the Russell 2000 has been kind of weaker on multiple time periods, in addition to showing us this weekly bearish posture that just showed up once again on the market forecast technical indicator here today. Regarding the other charts, we actually have what's known as bullish intermediate confirmation signals on all of the rest. And those signals exist when you have a bullish green line, which is again the intermediate line. So those two kind of words are used interchangeably. So green line or intermediate line, they're one and the same. And you can see with the green lines, the intermediate lines, they're all in the upper reversal zones on the other three charts. Now they're falling, but remember, we give it a grace period there if you make it into the upper reversal zone. So once you're in that area above 80, we don't really care if the green line is rising or falling. Now, obviously, if it was rising, we would think of it as slightly more bullish, perhaps, but from an official capacity, we consider that to still be a strongly bullish posture. Now, once we've identified a bullish intermediate posture, then the other part of the intermediate confirmation signal is what's happening with the red momentum line. If the red momentum line is in the low reversal zone on the same day that the green line is considered bullish, then that is a bullish intermediate confirmation signal. So that is the case with these other three charts right now. For those of you that are newer to that term, bullish intermediate confirmation signal, it effectively is a buy the dip signal because of what it's telling you. If you think about it and just break it down into two different pieces, remember that the green line is kind of looking at intermediate trends and telling us that the intermediate trend is reasonably bullish when it's in a certain position, like it is right now in the upper reversal zone. The red line is the most sensitive of all these lines on the market forecast technical indicator. And when it goes down quickly into the low reversal zone, it's basically telling you you have a little bit of a sell-off on your hands, and that's what we experience here today. So some people want to buy into the strength, but the downside of buying into strength is you might end up being a bag holder, right? You might end up buying the market right at its highs and then immediately watching it unwind right in front of you after you have purchased your stock or the ETF or what have you. So instead of doing that, some people prefer to say, I want to recognize that the trend is in place bullishly, but I want to wait for some sort of a pullback along the way before I take my ownership position within that trend. And so for folks that think in those terms, that's kind of a buy the dips mentality. An uptrend is in place, at least from an intermediate perspective, and then you're waiting for those pullback days to establish your position. So that would represent where we're at here today. Now, having said that, there are different ways to identify whether we think that the setup is, superior to alternatives. And in the case of the NASDAQ Composite, we would call that one not as ideal because we use this blue line to help us identify whether there's been enough of a sell-off. And in this case, the blue line being above the 50th percentile, notice in the label there it says 58th percentile. it still hasn't sold off quite enough for us to feel comfortable about the idea that this is a true dip. Whereas with the S&P 500, notice that it just barely got below the 50th percentile, so it's about as close as you can get to it at 49%. And then the Dow Jones may be a little bit more aggressive where it's at 37%. So we like to see it when that blue line is somewhere between 20 and 50 on the day of the bullish intermediate confirmation signal. And so for the S&P 500 and the Dow Jones Industrial Average, that does happen to be the case. Now remember, a week or so ago, we also had those signals set up. And for those of you that listened to my video, you would have recalled hearing me talk about the idea of the momentum line going too extreme. It was the day when the S&P 500 was actually at zero. It must have been that day right there on the 31st. So that can happen as well and kind of wreck your ideal setups, but that's not the case here currently. Remember what I said that day, the extreme reading on the momentum line is when it's below 5. All of these momentum lines are above 5 right now. So they're at 11, they're at 11, and they're at 8 on those three that have the bullish intermediate confirmation signal today. So today, it wasn't the momentum line that had any issue, and in 2 out of the 3 charts, we were good to go on the blue line as well. The only exception to that was the NASDAQ, where the blue line didn't quite get below 50. So anyway, different ways to kind of evaluate that setup there, but again, that's your buy the dips type of a setup there, and that blue line is kind of used to judge whether we have more ideal or less ideal setups there. Speaking of blue, congratulations to the fans of all the blue blood teams that made it into the Final Four over the weekend. What a tremendous weekend of college basketball. Also, of course, congratulations on the women's side to South Carolina. So those of you women's college basketball fans, congrats there. And great run out of your Connecticut Huskies as well. But on the men's side, big congrats there to the Kansas Jayhawks. Came back with a fury there in the second half last night versus North Carolina. Sure wish I could have been there in New Orleans as I was at the Final Four 10 years ago, but I couldn't quite pull off the trip last minute. And every moment I watched on TV, I was jealous and wishing I was there because that was some great basketball. Both the Saturday night game between Duke and North Carolina, and then again last night's championship game. So congrats to all of you Kansas Jayhawks fans out there. I'm already waiting for next March Madness. All right, let's go ahead and take a look at our 3 green arrows chart setup now. And this one will be chart 4D for those of you that are following along at home. And at this moment, we actually only have 1 chart left with 3 green arrows, and that's our NASDAQ composite in the lower left-hand corner here. Notice the background color of these charts on the chart 4D setup will tell us whether we have 3 green arrows or not. And so if the background color is green, like it is down here where I'm circling with the NASDAQ composite, that means that we still have 3 green arrows by the slimmest of margins. Now be aware that as soon as tomorrow, that will probably go away. The reason I say that is you'll notice right here on the MACD histogram, this gray bar you can barely even identify with your naked eye today. I can just barely see it there. Maybe if I right click and I maximize this, it'll make it a little bit easier. But to the left of my cursor, you'll see this tiny little gray bar right there that I'm circling, representing today's candle. And so if we have even a sideways day, even if the market's up a little bit tomorrow, there's a pretty decent chance that the MACD histogram will cross the 0 line tomorrow. If it's a big up day tomorrow, then maybe they can kind of turn the ship around here. But if it's just a very small up day, a sideways day, or a down day tomorrow, I would expect a red arrow to come in there on the NASDAQ composite, kind of telling us that some of the momentum is leaving the building, as has already been the case on the Russell 2000, has already been the case on the Dow Jones and with the S&P 500. So on all of those other charts, we have a mix of green and red arrows, with most of them still trading above their moving averages. So for sure, we've got our green arrows there, but the MACD histograms are our problem child right now in terms of the indicators, where most of them have turned red. Again, the exception being the NASDAQ composite here, our last man standing in terms of 3 green arrow status. Let's take a little bit of a break and step on over to the internet briefly. I always like to get a chance to say thank you to those of you that help support these market outlook presentations. Anytime we're up and over 100 likes, I always like to offer you a full-length video, including a trade application example, which is the case here today because 107 of you were nice enough to click like there for me last time around. Remember, there's 4 different ways you can find the link to the tweet in question. In case you were wondering, obviously the most easy way for those of you that are on Twitter fairly regularly is just come to either David or I's profile on Twitter, and we've got it pinned to the top of our timeline, right? There's one tweet that we can pin to the top, so we always just replace it with whatever our most recent market outlook video is, so that way it's easy for you guys just to come to our profile, click like right there. You can also click like directly under the video. For those of you that are watching it on our website at marketscholars.com, there's a little Twitter widget that we build into the web page there. We also provide a link to this tweet in the description area on YouTube. So remember, if you're just clicking like on the YouTube player, that's not the same thing as clicking like on Twitter. But if you, just to make it easier for you, if you look underneath in the description area on the YouTube video itself, you'll see that we list all of our little social media profiles and things like that, and we just replace that every time we do the video with whatever the direct link is to Twitter there. And then the last way that you can find it is on the emails that we send you guys. At the bottom of those emails, you'll find a little Twitter icon, and if you click on it, it'll take you to the tweet in question here. So there's 4 different ways just to make it easy for all of you. If you want to help support us and take 5 seconds out of your day to say thank you, we appreciate the information, we appreciate the effort, and we want you to keep them going. Now, having said that, here's the bad news. I will be out of town on Thursday. And so since I will be out of town, I won't be at my normal workstation. And so taking the day off and taking a little bit of a road trip since I wasn't able to get out of town last weekend. And so there will be no market outlook video this upcoming Thursday. As far as I know, David is still in town though, so you can anticipate that he would be able to do his video on Wednesday and Friday. So just a heads up there. But again, thank you to all of you that help support these presentations, including Dr. Bob, including Valerie, including AC, including Steve and SR and Iokipa and John and SW, Jeff, John, Dennis, Dean, Phil, Carl, BZ Japan, Wayne, Prickly Trader, Ron, Doug, Sheila, John, Julie, Serene, Greg, Brian, Paul. There's too many to go through, but sometimes it's fun to see your name in the light, so to speak. So I want to acknowledge you and thank all of you who were nice enough to click like for us there, and that goes a long way in our book. So thank you so much to all of you who did that for us. Also, while we're over here, let's go ahead and take a peek here at our sector selector. Oh, one other thing I should point out as well. Whenever I do the dividend growth investing updates, I like to mention it here during these market outlook videos because it's one of the areas on our website that is not behind a paywall. Obviously, my dividend growth investing classes that I mentioned earlier are behind the paywall, but my blog posts that mention the dividend increases once per month is not behind a paywall. So even if you're one of our free viewers on YouTube, you would have access to this information. If you go to marketscholars.com and then hover your mouse over the blog mega menu and then click on dividend growth investing, I'm just going to open it up in a new tab up here at the top to show you what this looks like. It'll basically take you to an area of our website where you'll see the breakdown of the increases from the prior months. And I did just update this from the month of March. For those of you that are premium members, I went through my analysis of these increases in the Monday afternoon Options for Long-Term Investors class. So feel free to check out that recording if you so desire. Otherwise, if you just want to do your own analysis on it, you can see all of those increases here on the website itself, including Best Buy, which remember, we actually have a sold put on Best Buy at this moment in time in this here market outlook video. So maybe some direct interest from that perspective there. But this was quite a smaller crew of increases compared to what we saw in January and February. Those months, there were hundreds of companies increasing the dividend. Here, we kind of stepped back down to just a few dozen of them that did so. So anyway, back over here to the sector selector. Remember, this gets updated on the website on Friday nights. and I'm going to do my best to still get this updated this weekend, even though I'm going to be out of town. I won't have all of my normal video recording technology with me, but I will try to bring a laptop or a tablet and try to do some of the tools that I normally would, as long as I've got access in my hotel room on Friday night. I assume that I will. If not, I will plan on getting it updated when I get back home on Sunday evening before class on Monday, where we reviewed this for our top-down trend trading class. But anyway, this last time around, you can see that energy did complete the clean sweep. I brought this up briefly last week, saying how rare it was for one sector to stay up at the top of the graphic for an entire cycle here. This is basically a rolling 13-week graphic here, and it is rare for one single sector to stay at the top. And energy was able to pull off that rare feat here officially. Last week, remember, we were looking at it and it was just slightly below number one, like back on the final week of December or whatever it was. But now, as you can see, all the way back here from January 7th to April 1st, every week along the way, energy has stayed number one. And remember how many times over the last 3 months you heard me use the phrase, it's energy's world and all the rest of the sectors are just living in it, or something along those lines, basically telling you that it's really just energy and everybody else is vying for second place. And now it's maybe a little bit more obvious that utilities and materials are separating themselves from the rest of the pack. But for a while there, we had financials that were doing well, and then they fell out of favor. So the one constant over the last 3 months is the strength in energy. Nothing else has really been all that constant along the way. Question, of course, is how long does that last? How long can energy stay at the top? How long can their strength continue and to be built upon? Of course, we don't know the answer to that. What I can tell you is that what we've seen so far is rare, but what I also can tell you is that energy was so darn out of favor for years and years and years that it wouldn't be completely unheard of to see them be number one for quite a long period of time to kind of offset being so out of favor for years. Now they could very well be in favor for quite some time. Maybe not years, but if we are in a high inflationary environment and if the war continues to rage on with Russia, Ukraine, keeping commodity prices high, who knows? Maybe these oil and gas stocks can stay strong for several months, and we'll all find out together. But if that does start to slip, obviously you'll hear me talk about it in these videos as well. But I have been impressed, by the way, with utilities there. So, don't want to discount them, but utilities have had a heck of a move here. A lot of times they don't get the publicity of other sectors out there because they're kind of viewed as some of the more boring areas of the market. But there are a lot of pretty nice looking utility charts out there if you're willing to open your eyes towards them, as well as some areas within materials like gold mining stocks and the like that continue to do pretty well. Unfortunately, our growth compounders remain towards the bottom, with technology, communications, consumer discretionary all continuing to struggle on a relative basis. All right, let's go ahead and get back on over here to the charting analysis. And let's go ahead and pull up our 12 grid chart, starting with chart 5A. This is our asset class 12 grid. And a reminder that the background colors of these miniature 12 grids are going to tell us what the current intermediate posture is using the market forecast technical indicator. So naturally, if the background colors are green, that means they have a bullish posture. If the background colors are pink, that means they have a bearish intermediate posture. So let's go through it. Let's talk about the most influential move today. I already hinted at it when we were going through our heat map, but just to put a ribbon on it, you can see here that TNX shot higher dramatically here today. We are at new multi-year highs for interest rates. The 10-year U.S. Treasury, remember, if you move that decimal place over to the left once, will tell you what the current rate is. And so right now we are at 2.55 or 2.56% on a 10-year government bond. So it's starting to get a little bit more substantial. Grab a swig of water there for some reason. Getting a little frog in my throat. Sorry. But anyway, getting a little bit more substantial on the yield, and who knows? Maybe you're going to show up at the bank and ask to see their table of CDs here one of these days. I'm not going to be the first in line there, but let me know how that goes for you. The point that I'm trying to make is at least it's part of a conversation again. In the past, where interest rates were next to nothing, or in some places in the world actually negative, obviously the idea of investing in fixed income really wasn't all that appealing. But perhaps we're going to get back to a world where that could start competing versus the stock market once again. And so interesting to see interest rates going higher. And again, a lot of that was off of Brainard's comments earlier here today. Now, naturally, when interest rates surge, as we've seen so many times in the last 3 months, the opposite impact happens on bond prices themselves. And so that chart over on the left-hand side here with TLT, which represents our long-term U.S. Treasury prices, you can see you took another big tumble here today, down another 2.2%. And we are basically, let me just double check this. Yeah, it looks like this was a new closing low. We didn't have a intraday low because we were a little bit lower there on March 25th, but on that particular day we didn't close as low as we did today on TLT here at 128.49. So, bad news keeps on coming for bond prices themselves right there. And it wasn't just the government bonds that got hit today. Notice that the foreign bond market was down about 0.86%. It also has a strongly bearish intermediate posture. And then high yield bonds also took a tumble here today. They were down 1.3% today. While they have held up a little bit better more recently, today they struggled, I think, partially because oil was down quite a bit more here today. Remember, high yield bonds are corporate bonds that have a hard time raising cheap capital, and so they have to be forced to raise expensive capital through the junk bond market. And many of those firms that have struggled in recent years are oil and gas companies. So we have seen oil prices obviously do quite well in recent months, but today they did struggle once again, and so I think that had maybe a slight disadvantage there. But keep in mind that we are still well off the lows on high yield bonds that were set back here on March 14th, whereas government bonds, which are generally perceived to be safer than junk bonds, they're actually at new lows. So I think it's the oil prices that have helped the high yield junk bonds stay elevated a little bit more than they would have otherwise along the way, but today was kind of an exception to that with oil prices selling off. Also note that gold prices sold off here today. They were down 0.63%, and this chart is starting to become a little bit more concerning. I'm not going to make a big deal out of it because we're still trading within the range of the last 3 weeks, but this is not the behavior you like to see out of gold all of a sudden, where you've got that dark pink background color telling us that we've got a strongly bearish intermediate posture with that line at 29 and falling right now. Not only that, but we are now below that moving average. Now, the moving average itself is still rising. Again, that's a 30-day moving average there. So that's why that color is yellow. So I guess that's the good news. But if we do stay below that moving average long enough, eventually that moving average will start rolling over, at which time the moving average will revert back to red. You can see that happened for one day right there on January 31st, and it did it one other day right there on January 6th. But otherwise, this has been an upward trending chart as gold prices have done pretty well this year. But you can see we are now well off the highs on gold that was set back here on March 8th. And so I don't think that's a particularly good look for it. I would have expected it to perhaps do a little bit better. Sometimes you see that when the stock market is down considerably like it was today, that gold somewhat benefits in response to that, being a bit of a safe haven type of an asset. But I think what kind of hurt gold here today was the chart you see to the left of it, which is the US dollar. This was an impressive candle on the US dollar today. Remember, we're talking about trillions of dollars worth of currencies changing hands. So sometimes, when I say that the US dollar was up 0.53% versus a basket of other currencies, you kind of think in your head initially that it's a yawn type of a moment. But all you have to do is just look at the size of the candle to the left of my cursor, and you can see that this is a somewhat large and exaggerated type of a day for a currency. And similar to how I was saying that the long-term treasuries might not be at an intraday low, but they're at a closing low. The opposite is happening up here when we're looking at the US dollar. We're now at closing highs over the last several months here all of a sudden. And remember, all else being equal, when the US dollar is strong, commodities can be weak. Now, there's a lot more that goes into it, but the general idea there is that commodities worldwide are largely priced in US dollars, so it makes it more onerous to buy those commodities when the US dollar is too strong. So we haven't really seen that because there are other interesting supply-demand dynamics that are taking place within the commodities world right now. Obviously, Russia, Ukraine has something to do with that. So that's kind of, shut off part of the worldwide commodity flow that we normally would have had. So that organic relationship between currency and commodity might not be quite as evident at this exact moment in time. But at least for one day, I would suggest that the big strength in the US dollar led to some underperformance in gold and oil here today. In terms of our charts up here towards the top, you will notice that emerging markets do continue to have a strongly bullish posture, according to the market forecast technical indicator with that green background. But EFA, which represents the developed foreign stocks, does not. It now has a weekly bearish posture there. And so we'll see, if that changes anytime soon. But a lot of folks have been watching what's happening with, Russia and China in particular in trying to gauge what's going to take place with the emerging markets. And we have seen a lot of those Chinese stocks, a lot of those Chinese internet stocks doing quite well in recent weeks. The Chinese government has kind of stepped in and more vocally supported them. And I think that's kind of given traders an opportunity to feel a little bit more comfortable with their positions in some of those Chinese stocks. Now today, again, an exception to that. We did see that the EEM was down 1.8%, so that did take a tumble, but I'm just trying to explain why we still have a green background color there. This has been a pretty solid move off the lows there after some of that Chinese news has been hitting the markets here recently. Let's take a look at our sector breakdown now, and so that will be chart 5C. And as I mentioned previously, this was a day that was kind of dominated by the defensives, right? DDD, day dominated by defensives. And what I mean by defensives are those kind of slower moving sectors, the areas that don't benefit as much from a strong economy, that are kind of more steady Eddie types. And on my setup here, on chart 5C, that's your bottom rung, and I set it up intentionally for that reason, because a lot of times they tend to travel together. Not always, but more times than not, you can kind of think in those terms, whereas your more cyclical and growth-oriented sectors are on the top and middle rungs there. But on this bottom rung, you can see that we have a clean sweep. All four of those charts are not only in the green on the background color, telling us that we have strongly bullish intermediate postures, but notice that all four of those sectors were up today, and they were the only sectors that were up today. Now, again, not by a whole bunch, but just to see that clean separation between the defensives and everything else, today was a good educational day to kind of grasp that concept. Healthcare was up 0.21% today. Staples were up 0.09% today. Utilities were up 0.63% today. Real estate was up 0.08% today. All the other sectors above it were in the red today. Our worst performer here today was, I believe, over here on the left-hand side. Yeah, it looks like it was discretionary, was down 2.34%. Now, remember, this is the market cap weighted discretionary here. I'm expressing that a little bit more dramatically right now because remember what I showed you on the heat map earlier. Amazon and Tesla both got hit pretty hard here today. And so they are two out of the big three that really control price action in XLY along with Home Depot. But with Tesla down 5% today and Amazon getting hit pretty hard as well, it shouldn't be a surprise that XLY really struggled today, being down 2.34% there today. We did see technology also struggle, somewhat of a similar conversation there. Remember back to the heat map that when I was showing you that NVIDIA was getting smoked today. We saw Microsoft and Apple struggling to a degree, and a lot of those semiconductors as well. So that kind of speaks to the reason why technology struggled here today alongside of discretionary. So today was kind of an interesting day where we had that clean breakdown between the defensives and the non-defensives. The defensive sectors actually finished in positive territory for you today. It's where you're going to find a lot of your dividend payers, and then the non-defensive areas, the more cyclical areas, you did see red across the board here today. In terms of intermediate postures, you will see that there are now 3 pink charts on the board. Now, they're all three light pink, telling us that we have weakly bearish postures on them, not strongly bearish postures. So I guess that's the good news. But those three charts are the financials, the industrials, and energy. The one of those charts that is most concerning to me, and I brought this up last week as well, so sorry to sound like a broken record here, but I just want to emphasize the point. I really don't like the way that the financials chart is shaping up. Now, obviously, that can bring opportunities to you. So if you're a long-term investor and waiting for some of those banks to pull back to more appropriate prices, this is, a moment where you can start, putting your shopping list together, so to speak. But you can see a very clear pattern here on XLF of lower highs. Peak number 1, peak number 2, peak number 3, all of them consecutively lower. In addition to that, you can see low number 1 and low number 2, obviously lower there as well. So the fear could be that the financials could end up coming down and breaching these prior lows from March. I hope that doesn't happen because the financials are kind of like the lifeblood of the stock market. Those banks finance a lot of economic activity. So I prefer to see the banks holding up, but obviously it's not my choice. So I'm just don't shoot the messenger, so to speak. I'm just letting you know what I see. But notice that today was actually the 5th straight down day for the financials, and we've sold off enough recently where that moving average has turned back to red because the moving average stayed going lower during this entire counter trend move that we had here off the oversold cluster signals, and now we're back below it, trading below it. So price is back below a falling moving average. And remember, I pointed that out to you in real time on that day, on March 29th. I was observing that day when we were going through this normal 12 grid analysis that, it was a great day for most stocks, but the financials were a concern of mine at that day because they closed in the lower half of their range. You can see here that if you glance at all of the other charts, there's a little vertical gray line above that exact day. I've got these charts set up to do that. So that was March 29th on all the rest of the charts. Look at all the rest of them with that gray line going through all the rest of the charts. Almost every single other chart, the sector closed at the high of the day. The financials stood out like a sore thumb because they closed in the lower half of their range. And the only other one that kind of looked that way to a degree was healthcare. Down below there, you'll see that it closed maybe at the exact middle of its range. But the financials on that day closed in the lower half of the range. And I think that knowledge helped you kind of understand why there was going to be some selling on the horizon immediately after that. And think about what happened today as well. This is another good point. Interest rates were up tremendously today. Today was like a breakout day with interest rates. Typically, when we've seen that in the past, financials have done pretty well on those types of days. But even today, they still can't get out of their own way and had their 5th straight down day. It'd be different if they were, up yesterday or the day before, and they had to just give a little bit back because the overall market was down today. But we're talking about piling on, right, on the dog pile there, day after day after day of selling, and even spiking interest rates couldn't pull them out of their funk. Now, part of that is because of the inverting yield curve, and that's not really helping support some of those banks either. But nonetheless, it's been kind of interesting to watch those financials struggling here recently. So that's the chart that is most concerning to me. Industrials are getting hit 5 days in a row here as well. You guys have seen me starting to tweet about the transport stocks here recently, those of you that follow me on Twitter, and those truckers and even the rails are really getting smashed here recently. So I think that's a big reason behind the move lower in industrials. And then with energy, I'm not really reading too much into it at this moment in time. Yes, it's true. The intermediate line fell out of the upper reversal zone. It's at 77 and falling right now. But you'll see that we still remain reasonably high above that moving average. And really, if anything, I think energy is just kind of consolidating sideways because it went up so fast earlier in the year. This was a spectacular move from February 25th up here to March 8th. That's probably right when the war was getting started there in Ukraine. and energy just took off like a rocket ship. That was not normal behavior right there. So what we've seen since then is just a consolidation sideways. So I'm not going to get too worked up about the weekly bearish posture on energy just yet. If this starts closing below its moving average repeatedly, that's a different story. But right now, I'm just assuming this is a normal type of, blowing off the steam sideways type of a move like we saw back here, where it eventually touched the moving average, used it as a launch pad and went up, came back down to the moving average, used it as a launch pad, went back up again. And if it comes down to this moving average, uses it as a launch pad back higher, I think there's a decent chance we could take out those previous highs from back here. Again, assuming there's not, peacetime or something like that, a news story that could impact commodities prices. But right now, I'm not as concerned about energy as I am with what's going on with the financials, and to a smaller degree what's going on with industrials there. All right, so let's go ahead and talk about our trade application example for the day. And I'm going to pull up chart 2A. Most of you that know my routine should not be surprised that today is a day where I wanted to focus on a sold put opportunity. I try to preach this to my premium students, and some of you that are even our free members here on YouTube can probably get the sense of my style along the way, as well as it is a go-to strategy of mine. I like to be brave on days when the market is selling off hard. Those are days where I prefer to be a put seller, not the opposite way. And some people get confused by that because they say, well, isn't put selling a bullish strategy? And the answer to that is yes, it's neutral to bullish, but it is definitely bullish compared to bearish. But the reason I like doing it on days when the market gets hammered, like was the case today, is because volatility has risen. And if you can sell puts with higher volatility with the expectation that volatility will be crushed out of the system, which oftentimes happens, you're giving yourself an embedded advantage that a lot of people don't recognize. So I like to use these opportunities and almost force myself to sell puts on days when the market is down at least 1%, and today that was the case. So let me share with you the stock in question. It is a lesser known company to a lot of you probably. This is Polaris, ticker symbol PII. This is a smaller company. It's a mid-cap company, to be fair. It's like a $6 billion market cap. But it's obviously not, a company that you hear talked about all that often. For those of you that enjoy your snowmobiling, I've never once been on one, despite having grown up in South Dakota. I probably should have been on a snowmobile somewhere along the way, but I need to check that out at some point because I think it'd be pretty fun. I've been on a few four-wheelers, and they make four-wheelers as well. But Polaris is a well-known name for, recreational vehicles. And, they belong to the consumer discretionary sector. Just got done telling you a moment ago that consumer discretionary was the worst sector here today. Not only that, but I showed you earlier on the sector selector that consumer discretionary is also in last place on the sector selector tool. And so, again, I want to be brave when others are selling off certain segments of the market and try to sift through the rubble to look for opportunities, right? See if there's any babies that have been thrown out with the bathwater. And one way for us to try to identify that is by looking at stocks that have long histories of growing their dividends. So that's a fairly common opportunity that you'll see me present to you, is that I usually focus on stocks that have a decade plus of dividend increases, and that is the case with Polaris. In addition to that, I look to find those situations where stocks are really getting beaten up, not just a little bit sold off, but getting hammered home pretty hard. And today, Polaris was down 4%. Now, the real reason that it crossed my desk is because it gave me an oversold cluster signal on the weekly candle chart. That's what that little green dot underneath the bar is showing us. These are our weekly bars that we're looking at here. This is a full 10 years worth of information we're looking at. And these little green dots appear when the selling has gotten a little bit overdone to the downside, or at least that's the way I want to think about it. Obviously, nothing works perfectly, but it does a reasonable enough job where it can be useful for put sellers, where you're kind of putting yourself into a favorable position right out of the gate because of where you're selecting your deltas and your return on risks and things like that, right? You don't have to be perfect as a put seller if you're selling out of the money puts. You just have to be in the general vicinity of where you think a bottom might be starting to be formed. And so if you look back throughout history on this particular stock, you will see that these green dots were appearing back here in 2015, just as it was about to bounce in January of 2016. You also saw a big chunk of these green dots show up at the end of 2018. Remember, that was the year we had the bad Christmas sell-off. And of course, that led to an eventual rebound here as soon as January of 2019. Then you had this one kind of all by itself lone green dot right here at the exact lows. I know it's hard to see. One thing you can do if you have a premium membership with Market Scholars, you can come in here to the little gear, actually not the gear, it's the beaker icon. And if you just get rid of those dividend bubbles right there, you can just hit the X once you go in there and hit OK. That will remove those little yellow bubbles at the bottom, and sometimes it's a little bit easier to see. And I'm glad I did that because I didn't know initially that there was 2 green dots right there. So on the week of March 23rd, 2020, and then the following week, March 30th, 2020. Remember, that was the exact low of the coronavirus wipeout. You also got those little green dots to show up, telling us that we had oversold clusters using the market forecast technical indicator. And then fast forward to where we're at right now, we had a couple of those little green dots show up late last year in 2021, which led to a rebound up to about $120 here for the first few months of this year. But now you can see what's happened. That entire move here has been unwound. And so we've had a pretty harsh sell-off from, approximately 126 down here to about 103. And now all of a sudden we're getting this little green dot to show up again. Now, the way that I teach this to my dividend growth investing class is that we generally want to be buyers of long-term securities when they cross into this blue zone of the dividend stair-step chart. And remember, that blue zone is going to be different for every single company. So I had to do about 1,400 calculations in order to do this particular blue zone this last year, because I need to do the updates once per year. But anyway, for Polaris specifically, it usually is an attractive investment when you can get at least 3.01% dividend yield out of it. So this blue line down below will show you where does the stock need to go to in order to have that yield, because right now its yield is 2.47%. So obviously when a stock price goes lower, its dividend yield goes higher. This blue line will help you understand visually how much lower it has to go before it becomes more attractive. So this stock would have to fall from 103 currently down here to 85 at a minimum before it would kind of meet our long-term rules. And that sets up an opportunity to sell a put on it. And what I ended up doing was selling the $80 put. And that is for the month of May, and I was able to get 80 cents for doing that. And some of you might have been able to get 80 cents, some of you might have been able to get 85 cents at the end of the day there as it sold off towards the close there and opened up that opportunity. I think it actually closed exactly at 80 cents. Yeah, it did right there, exactly at 80 cents, and that is where we got filled as well. But anyway, 80, as you can see, is well into the blue zone here. If it closes down there at $80, then we have to be willing to buy it as put sellers. But the chances of that happening depend upon what's going to happen in the market along the way, what's going to happen with consumer discretionary sector, consumer spending, that sort of thing. And you have to remember that you do have an earnings announcement along the way. So this is not a trade for those of you that don't want to take ownership of Polaris. If you're taking a trade like this, you have to be comfortable with the idea of buying this company down here at $80 per share, where it will then have well in excess of at least a 3% dividend yield. If that doesn't happen, then that $80 that you took in today as part of the credit that you sold when you sold the put, that's yours to keep. So I kind of think of it as a parting gift on a game show, right? That's something that's yours to keep. But the grand prize is if this thing keeps on falling down to 80, then you get to take on this higher quality stock at a level that is more attractive on a long-term perspective than where it's priced here today. Okay, so that was our trade application example for the night. I'd also mention that it looks pretty good on a PE ratio basis, right? It's trading at 11 times earnings right now. And it's not quite as cheap as where it was at the worst part of the coronavirus sell-off when it got down there into the single digits. But it's basically, with the exception of that abnormal event of the coronavirus, at basically its cheapest valuations at this moment in time as well. So perhaps that's makes it a little bit more intriguing there. So that's what I had for you here tonight. Hope you got value out of the video. Remember, I won't be with you on Thursday because I'm going to be out of town, but I would certainly appreciate a like anyway if you got value out of this video, and I'll do my best to get a full-length video for you a week from tonight when I'm back with you next Tuesday. David should be here with you along the way, by the way, but I do want to wish you all the best of success with your trades and your investments, and I'll see many of you premium members tomorrow morning in my factor-based swing trading class. For the rest of you, have yourself a wonderful weekend, and I'll see you all next Tuesday. Take care, everybody. Bye-bye.